Well, with that context, let's get to today's market action. Joining me is Ariel Investments Vice Chairman Charlie Bobrinskoy and Vital Knowledge founder Adam Crisafulli. Guys, happy Friday. Welcome. Charlie, we closed above 5,500 on the S&P. Haven't been here since before the tariff announcement. Now, you say you've been bullish, but now you're bearish. You also say to sell growth and buy value. But how's that different from what you've been saying?
Well, for 5 years, I think I was saying that equities look cheap, particularly value stocks look cheap, and that people were too pessimistic about the economy, and therefore cyclicals were inexpensive, and you should invest there. And I think the difference is that today, I'm a little worried that with this rally, we're whistling past, excuse the metaphor, whistling past the graveyard. A trade war would be extremely negative to the economy. And although there's been some signs of backing down from the outrageous 100 and 140% tariffs that we were talking about, I still haven't heard anything that says that the current administration is going to give up on the core idea of at least 10% tariffs. And that would be, we're already seeing the impact of less goods coming into the ports, less trucking, less items that are going to be on the shelves. I think we have a much higher chance of a recession than we did 2 years ago. And so I think, if anything, people are not worried enough about the effects of the trade war.
Okay. Well, Adam, the dominant market mindset this week seems to have been maybe it won't be so bad. You know, maybe it's some of the China tariff indications of flexibility from the Trump administration, perhaps, maybe less Peter Navarro, more Scott Bessent. But is that safe, especially as we look at the beige book, the soft data versus the hard data, and now this Fed report also, there seems to be this continuing disconnect between soft and hard data.
Yeah, so we've had this ebb and flow now for the last several weeks. So remember, on Monday we were flirting with about 5,100, and we've had a very healthy rally since then, driven by decent earnings. You can't forget about earnings. Corporate America, performed better than feared in Q1, and then also we had a lot of hopeful rhetoric out of the White House about striking trade deals in the coming days with certain countries. It seems like South Korea, India, and Japan are furthest along in that process. These might just be memorandum of understanding or frameworks of deals, not actual deals. And then also you've had some indications of de-escalation on both the part of the U.S. and China in that trade war between those two countries. So definitely a lot of hope on the trade front. But at 5,500 now, I think it's time to fade the rally rather than chase it, because we've already priced in a lot of the trade optimism, and on an absolute basis, we're still talking about very significant tariffs that will be in place even after these deals are struck. And that's something that will have stagflationary implications for the economy going forward.
Okay, so Charlie, if people are looking for what to buy, you say certain regional banks could be an option here. But why, given the Fed financial stability report, and if the consumer is going to get here, presumably small businesses will too?
Yeah, we're still seeing that credit is holding up very well at the regional banks. Bank of Oklahoma just reported a zero credit loss for the current quarter, and it's trading at 1.05 times book. My grandfather bounced me on his knees a long time ago and said, buy them at 1, sell them at 2. Buy regional banks when they trade for 1 times book and sell them when they get to 2 times book. We have some of the strongest banks in the country trading very close to book value. So I think regional banks are very appropriately priced, which is different from large cap growth, which is still expensive. So look for what's being discounted right now, what's trading at valuations way below its historic averages. That's regional bank, that's housing stocks, that's auto stocks. Those are the things that are cheap right now.
Charlie, how does the rally this week set us up for a week coming where we've got some pretty major names, particularly in technology, reporting?
Do you want me to take that one? I'm happy to.
Actually, no. Let me give that one to Adam, since I gave you the last one, Charlie. Sorry. Adam, go ahead.
So I would say out of all the major subgroups, tech has had the best earnings season so far. Google last night was just the latest name. You had Lam Research, ServiceNow, Netflix, SAP, Text Instruments. A lot of positive results out of tech. Tech has traded very well as a result. So now the bar is a little bit higher into next week. And like you mentioned, we get a lot of major tech reports: Apple, Amazon, Microsoft, Meta, and others. It looks likely, though, that the group will continue to outperform as far as just fundamentals and, being relatively or less immune to tariff fallout versus some other sectors, just given the nature of software and how it's largely not being impacted directly, at least by the trade war.